Hey guys, Max here, and yesterday was another tough day in the markets. Stocks fell across the board, tech did particularly bad, and once more, it was all based on something that has actually been present in the markets for months now, but only suddenly have investors paid it any attention. We are, of course, talking about inflation, interest rates, the Fed's bond buying program, money printing in general, and how it's all going to go in the opposite direction. So let's just get right into it. Now, to start off, what actually happened in the markets? Well, as I said, stocks fell. The S&P 500 fell by about 1% by the end of the day. The Nasdaq fell by about 2.2%. Now, there is a stock market map, and that shows it pretty well. As you can see, tech got absolutely hammered. Consumer staples, healthcare, and energy did better, rising for the most part. The Stoxx 600 was down minus 1.5% and the FTSE 100 was down by 0.2% as well. Europe obviously didn't do much better and also saw decreases in equity values across the board. So to start us off then, why did consumer staples and healthcare do well again? Well, for the exact same reason they did well yesterday. Health is seeing a slight rally off of the potential of another COVID wave as a new variant has been spotted in China, and that country is currently seeing its highest ever daily case count. So lots of healthcare plays are being made right now. Now consumer staples are pumping a little bit off of the idea of a recession, which is finally becoming mainstream. It just isn't really feasible that inflation is going to be curbed without us falling into a recession right now, so markets are starting to price that in. Deutsche Bank actually became the first major bank so far to actually predict one is coming, not just with a 30% probability or something like that, like American banks have predicted, but to outright say that a recession is more than likely going to come. So investors are finally having to consider that reality, and consumer staples are a bit of a safe haven for that. Think of companies like Procter & Gamble, Walmart and Costco, all companies that might not necessarily benefit from a recession, some of them do, but they won't get hurt as badly as other companies. Now, of course, the really big topic that we're going to talk about today was the minutes from the Fed's FOMC meeting coming out, and it was hawkish, and these minutes caused a crash back in January, and it seems like they might be about to do the same in April. So what exactly was said, and what are the concerns, but also what are we really hearing from? Well, the FOMC is basically the meeting where the Fed officials discuss interest rates, the Fed's balance sheet, inflation, quantitative easing or tightening. And this meeting happened almost a month ago, but the minutes or basically the transcript of that meeting is recorded and it's then released about 3 weeks afterwards or yesterday. So we're finally able to see what they're saying behind the scenes, how scared of inflation the Fed is and what they're planning in the future as well. And in short, the Fed is more hawkish than markets thought they were. Now, the first thing that the Fed actually spoke about was the prospect of raising rates by 0.5% as opposed to 0.25%, which is a much sharper increase. And here the Fed indicated that they are fully prepared to do that if needed, which is worrying to the markets. To be perfectly honest, we've covered this so many times in the past, so I'm only going to explain it very briefly. But as interest rates rise, everything becomes more expensive for businesses and people too, but businesses especially find it harder and more expensive to grow and more expensive just to continue functioning as well. So they see their valuations take hits and asset prices they fall as future cash flows decrease. Harsher interest rate hikes then bring asset prices down across the board more than light interest rate hikes, which is one of the reasons why stocks fell yesterday on this news. Now, the next important thing that was said was that quantitative tightening is a distinct possibility and actually a likelihood as well. Now, this is the opposite of quantitative easing, and instead of throwing money into the markets, it basically pulls money out, and that's bad for asset prices. In particular, the Fed said they could reduce Treasury holdings by as much as $60 billion a month and mortgage bonds by as much as $35 billion a month. This would mean the Fed selling on the open market bonds worth $95 billion a month. That would basically crash bond prices and send yields soaring, which would make debt servicing far more expensive. So again, equity prices would then decrease as a result of this as well. Now, this number isn't actually that big, and this is the upper bound of what the Fed would be looking at. And even if they did run at this hawkish rate, it would take the Fed, I think, 17 years for them to get rid of their entire balance sheet. So really, it's not as bad as it could be or as bad as investors think it is, but it is far worse than they were hoping. Really, what investors wanted to see was a notional attempt to reduce the size of the Fed's balance sheet, something closer to $10 or $20 billion a month, so the Fed can claim that they're fighting inflation while in reality just letting it spiral out of control in order to protect asset prices. Basically, these minutes saw investors panic a little bit as they realized that the party is not going to continue, if we believe what the Fed has to say at least. The problem is, I personally don't believe what the Fed has to say because they have lied to everyone repeatedly over the last year. It is clear that they are targeting what's being dubbed a soft landing, basically trying to curb inflation without causing a recession, but I just don't think that's possible anymore. We are too late in the inflation cycle for that to be a realistic possibility. Instead, then, the Fed has to decide if they tackle inflation and cause a recession and crash asset prices, or if they allow inflation to continue to spiral out of control, allow the bull market to continue for another couple of years, only for someone else to have to crash the markets and cause an even worse recession. I think it's clear what the lesser of two evils is. I just don't think that Powell is prepared to take that action when he could instead just coast along until his term is up, stay very wealthy, retire, and leave this mess for someone else to clean up. Now, the dollar did quite well again, and that continued to rise slightly against the pound, the yen, and the euro. Now, this is confusing to a lot of people. The news that the markets are embroiled in is surrounding the fact that there's not much chance of a soft landing for inflation in the US, and so a recession is probably going to arrive anyway. So why is the dollar strong on this news? Well, pretty simply, it's because contrary to what a lot of people want to be the case, the dollar is still the safest, most widely accepted and used and demanded currency in the world, so it is still a safe haven, and investors would rather hold it than anything else for the most part, gold and crypto and the ruble and yen and yuan included. Now, the ruble has actually continued to par its losses, and it's now sitting pretty much where it was prior to the invasion of Ukraine. Of course, the value of the ruble collapsed overnight as all of the news of these sanctions started flooding in, but then it slowly started to recover. Again, I see a lot of people claim that this is due to the failure of the dollar, the end of the petrodollar, and a bunch of other things like that, but there just isn't any actual evidence to support that idea. What is going on is that Europe and the US aren't willing to walk the walk when it comes to sanctions against Russia. They aren't willing to take pain themselves in order to inflict pain on Russia. The SWIFT ban, for example, that we were told was going into effect, has left half of Russian banks uninterrupted, and those that aren't targeted are the biggest, most important banks as well. The EU has bought over $30 billion of natural gas since the invasion started. Plenty of oil has been traded as well. There are 6,000 key supporters of Putin who are in need of sanctions if they are to actually work, yet only a few hundred have actually been hit. This is typical Europe, unable to make the tough decisions that are needed to ensure safety and prosperity in the long run, and it shouldn't surprise us, but it should worry us. Now again, there is loads of talk going around right now of finally cutting off oil and gas imports from Russia, and actually cutting Russia off from SWIFT and things on the development of the war crimes committed by Russian troops in Bucha in particular, but again, this will probably all come up short. Now, in the world of bonds, we saw another dangerously volatile day with the US 10-year Treasury yield rising another 6 basis points to a new 3-year high of 2.6%. We saw similar movements across the rest of the world as well, with the British and German 10-year yields advancing 3 and 5 basis points each. Debt servicing continues to get more expensive, and this is fully expected, even if some people are expecting a turnaround soon. Personally, I'm not. Bond yields are probably going to double from here on out over the next year or so. Now, oil prices did fall once more, which is really welcome. WTI crude oil is now sitting at $97 a barrel after falling 5% yesterday. Brent crude is sitting at around $101 a barrel. It is really nice to see some more downwards pressure on oil. This is probably a response to a few things, notably the release of the US strategic reserves of oil, which is why WTI, the standard of oil in the US, is dropping quicker than Brent crude, the standard of oil in Europe. Gold prices, again, held pretty firm, no real inflows or outflows. I think, though, in the long run, gold does still have some room to move upwards, but this hawkish talk from the Fed is probably convincing some to hold off on moving into gold yet, but I'm firmly in the camp that inflation has not yet peaked. Finally, in the world of crypto, we've seen a couple steady days of declines. Back on Monday, Bitcoin was sitting at around about $47,000, actually above that, and it's now fallen to about $43,000. Ethereum was at around $3,500, and it's fallen to about $3,200. Again, this is the same story seen across altcoin markets as well. Most random projects, if you pick one out of a hat, it probably lost 5% yesterday and the day before that as well, or something in that region. Now, there is no crypto-specific news for this across-the-board decline, but this is an example of crypto being a risk-on asset, not risk-off as so many claim. The reality seems to be that when traditional markets are volatile, either upwards or downwards, crypto moves in the same direction, but when traditional markets are a bit more stable and steady, crypto then tends to move on its own accord, reacting to crypto-specific news like that announcement from the UK the other day about allowing crypto-based innovation to prosper in the country. With that said, that basically means that the reason crypto fell over the last few days is investors are just worried about the monetary environment, and because crypto is not a niche market as many people claim, loads of normal investors have allocated a portion of their high-risk portfolio that would usually go into things like Nasdaq-listed tech companies to crypto instead. And as it's so risky and volatile, when risk sentiment turns around, crypto is the first thing to get liquidated in people's portfolios and replaced with something a little bit safer. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Thank you all for watching. Stay stoic. Until next time.